times and I felt that maybe then to wait up until get the final time. But yeah, I can confirm that as far as I know, it's going to be online. Not unless then they will can change then some things along the lane because they've got the power to do so. Our last chapter then is chapter 12. I'm starting then on my presentation now. Chapter 12 is a contract costing. It's not that long now when it comes to the calculations. Yes, when we look at the theory side of things, then there's a lot. It's a little bit longer than other chapters, but I'll try then to simply do the summary then for us. But what then do we need then to know when it comes then to the theory that is behind then the practicality of then this chapter, which is contract costing. These are the figures that go to the credit side. So I'll show you how then to handle that. Then, as you look at the assessment, what is going to be expected of you is to prepare contract accounts, including extra work and certified work, determine the profit and loss on the contract account. Those are the two things that we're doing. Then, when we're preparing this contract account, we are calculating the actual cost that we incur at that particular period and the profit that we realized or the loss that we may have at that particular period of doing our financial reporting. So let's move on and look at our introduction. So they start there explaining the differences between contract costing and job order costing. Because then when you look at the two, you can say that there are certain similarities because both of them then you receive your client came then to you making a request, but look, this is what I want you then to do. But there is a little bit difference when we look at the contract costing. Hence, they are saying that when you look at the contract costing, the main work is done on site, while with job order costing, the job is done on the contractee's work. So, in other words, when we look at the job costing, someone came then to me and say, look, I've got this card and that I need you then to service. So I'll say then bring then the car. It's rare then to say that okay, I'll come then to your place then to fix then your car. Only if then it's a minor issue then and the car is not moving. But when you look then at the contract costing. So we're looking then at the situation where one will say that I'm looking for someone going to build up then a house then for me. So no one can say that okay, I'll build the house and in my own site and then I bring it for you. I've never seen that. I'm talking then about the house, not then the shack. Well, probably then that could be possible then when we talk of then the shack. But when we look at the proper structure, then a contractor needs then to go then to the place. So that's a difference then that we are talking about. If then we can say that in our institution, we want then to do then some extension to build then new auditoriums. So they can't build these auditoriums then at their place. They have then to come then to our site, occupy a certain space where they will put their material, probably even their labor, then can have then some structure there then to sleep so that they can conduct the job. Again, in job costing, profit is recognized on the day of delivery, while contract costing, due to the duration of the contract, revenue is recognized based on stage of completion. So that's what we're looking at when we look then at the contract costing. So that's then again another difference then that we encounter on that. There's the characteristics of the contract costing. There's a high proportion than usual of indirect cost. Items normally classified as indirect cost can be identified specifically with a particular contract. So that's what is also good when it comes to this contract costing, because we don't waste ourselves on classifying the accounts then as we normally used to do then in financial accounting. But we just look at this account and say, no, it belongs then to that contract, whether it's a direct or indirect cost. But what we need now is a cost that belongs to a particular contract that we are working with. Hence, they are giving us an example then of then the telephone cost, then of the site office, can be charged directly to the specific contract. So we can't say that no, this is an indirect cost, but we said, look, this is a cost that we incurred. Why? Is because then we were assisting then the particular contract that we're working on. So then the cost belongs to the contract. There are low indirect costs, as we've explained that. So that's another thing then that we come across then to that. So they've explained further, but then what I will jump to then is the terminology then that we have. So they look at also then at the pricing. So we've got a fixed price contract where they say the price is inclusive of all necessary steps then to finish the job. Disadvantage is that if costs escalate, quality of work might be compromised. That is why then you normally use then to see then the uncompleted then a road for argument's sake is because of then the fixed price contract. So while he or she was working then on that particular job, he realized that, you know what, I'm going to make a loss here. So let me just say that I've done everything so that at least I can have the profit. But yeah, there's a lot of things that are happening which I don't want us to go there. Cost plus contract price. Then this one is a safest one, where they say unforeseen circumstances may arise, led to the inclusion of a cost escalation clause. This stipulates the adjustment of the contract price if there is a change in material price or labor payment. Usually then I've heard that, especially then when it comes into the municipality, this is then the clause that they were used then to, but it was exploited and a lot by those tender guys, because they took this as an advantage, saying that the prices are escalating, they're high, although then there is no such, but just for them then to realize the price. But there is another option that they are using. I'm still going to investigate for you, and we do then some of the updates in our syllabus. Now there are terms that we need to familiarize ourselves with when it comes to the contract costing. The first one is a contract price. So we need to know about what are we talking about. When we talk of then the contract price, they say now price for the work done by the contractor per stage of work completed. So we call that's our contract price at that time. That's the amount that we are expected then to pay to then our service provider. A contract costing can take place over several accounting periods. Therefore, contractors then will claim certain payments for the work successfully completed. So we call that as our contract price. We're working at this is then the price at this particular stage. Then the second term that we have is a certified work. So progress payments are made during the course of the contract. This is done according to certified or certificates that are issued by the client supervising architect or quality surveyor or engineer at specific stage of then the work. So this is what's happening. If then we're talking about the building, after then the contractor done the foundation, we'll call in our architect or the quality surveyor to come and supervise and check then the work that is done. And you look at then the work and said, okay, as we know then, okay, looking then at the total work then of this particular project, I can safely say now 5% is done. So if then we are saying then 5% is done, what we'll go then to do, we'll go and look at the total amount. If then the total structure, then we had an agreement of 2 million. And say that this is a total amount that we are going to pay you after you've completed or for this particular project. Now that then the architect say that at this point in time you've done 5%. So as a contractor, you are entitled then to the 5%. So that's yours. That's an amount that belongs then to you. So out of that 2 million, you can claim 5%. That's what we are saying. So all in all, then the amount that you can claim is 100,000. So we can say that so far, it means that 100,000 is yours. You can claim. So this is then the certified work. That's what we're talking about. These are the progress payment that are made during the course of the work, and how then the payment is made. Then we need then that certified in our work. So a certificate specifies and the contract value of the approved work completed up to the date of the certificate. Therefore, the basic formula then to calculate this, and as I've said, is a cost incurred to date divided by the total price. So this one we say that is a contract price is what then you can claim, but we'll come back then and check then to or the formula to calculate the certified work as they've indicated here. That is a cost incurred then to date divided by your total contract price. So we'll check and see then, okay, if then a 5% is done, you've done this 5% at what cost? Probably then you can say that the amount that I've spent is 80,000. And according to our calculation, the contract cost is not 2 million at this stage because you only completed 5%. So you're entitled then to 200,000. So it's going to be your cost, that is 8,000 divided by the total cost of 100,000. Then we determine the amount then that we can pay you. So these are the nitty-gritties that then unfortunately or fortunately, I don't know, our contractors, they failed then to have got a good understanding on this. Because once we say 5% is done and that is equivalent to 100,000, automatically you find these guys claiming that, okay, I've got 100,000 rands cash, not knowing that then we still have then to justify that amount and said out of this amount, this is what you can claim. So they went there and buy then now several cars and all those things, hoping that then they have got the money, but they will use only the certificate. And again, out of the amount that you can you are entitled to claim, you'll find that again in a contract there's this clause of the retention money, where it is usually for clients to withhold a certain percentage of each progress payment in order to protect themselves against defective work by contractors, especially when we talk of the building. Because once the structure is completed, we know that for a several period of 6 months or so, we need to monitor then that building for any cracks that can come up. So if there are those cracks that came, then we go then to the client and say, look, you have to come and fix. There is a problem then in this structure. If you refuse then to come, we are going then to use the amount that we've hold then for you, then to hire someone else to come and do the service. So then this is the term that we're using then to protect us. Then when I'm saying us as owners or their contractees, then against then the contractor, because someone then can decide then to disappear then with the funds, if then you can just pay every cent to them. The next term that we are going to encounter here, they call it uncertified work. So this is what is happening here, guys. Let's say then we've got this contract of a period of 3 years in total. Now we look at the year 1. That's your year 1, year 2, then the last year. And the agreement says that for after each and every 6 months, the inspector then will come then and monitor the work that is done. Or let me say that 8 months period. So on the 8th month of the work, then the inspector came and said, okay, 10% is done. And after that, then we completed or we've run then the work for the next 2 months to finish our first year. And then this first year, the 12th month, then we have then to do our books as a company. And we are only certified then to claim for the work that we've done from month 1 up to month 10. So you've got this work that you've done in this 2 months period. You've done something, you've spent your material, labor is in there, your overheads are there. But the question is now, can you be able to claim for that 2 months period? The answer will be no, because it is uncertified. We have to wait again then for the next 10 months period so that the inspector will come and do the inspection. So then by the time we are closing our books, to protect ourselves as a company, or to have then the clear idea of the profit that we've realized at the point of closing then, or reaching then at the end of the year, we call that as uncertified work, and we are going to take it out then in our calculations. We will see that when we do the calculation, so that we can do the adjustment of the costs that we've incurred against the amount that we can claim. So that's what they are talking about when they are talking about this uncertified work. Hence, they're saying a determination of the work done for which the architect issued his certificate is done at times to which the parties then agree. If then we say that that's a 10 months period, for each and every 10 months you come, then it is not necessarily done on the last day of the contractor's accounting period. That's where the problem starts. And there will usually be a portion of the contract that has progressed since the issuing of the last certificate. The last certificate, or the first certificate in this case, was issued to us on the 10th month. So we've got the extra work that we've done for the next 2 months, and we don't have certificate because we have to wait for another 10 months period. Then a cost of uncertified work must be determined at the end of the accounting period, and it is shown as work in progress as an asset in the statement of financial position. So we determine then this cost and we put it on the credit so that it can stand out as one of the asset, because it means that this uncertified work account is going to have the positive or the debit balance to indicate that is an asset. I know then I might probably confusing you then, but when we go then to the calculation, you'll be able to understand clear than what we are talking about. Material then on site, then that's another term that we are going to come across. There is usually unused material ordered specifically for the contract on hand at the end of the accounting period. Unused material is valued at cost, carried over to the next period, shown as an asset in the statement of financial accounting period. Because what is happening is you may find that our main site is here in East London, and it happens that we've got a contract. Then we've got a customer then that need us then to do then some work, let's say in King Williamstown. So we need then to move a certain material then to that particular site where we are going to have a structure, or we're going to construct then the structure at. So looking then at those, then that's where then at the end of the day we'll find that there is material that is left there at the site that is unused. So we call that as a material on site. The next one is the extra work. Imagine then we are building here, let's say then the classrooms or the offices. Upon then when we're working then on these offices, your client can say then to you, man, look, we are going to need also the cupboards here. Can you help us with that? If then you've got someone then who've got the skill then to do then the cupboards, you can say, okay, no, that's fine. But that was not in the initial contract. This came as an extra work that you are going to do. So that's what we call as an extra work, and we are going to accommodate on this contract. We're not going to open up a new contract. We give that a term and say that this is an extra work. Also, then the reserves or provision for contingencies. This is an amount then that we reserved us as a contract. A contractor is saying, okay, instead of spending all the profits that we've made, we don't know what is going to happen then tomorrow. So if then I will receive an amount today, let's save some so that we can cover then our backs. If it happens that come next year, COVID strike, then now they come and say, okay, now look, then we're on lockdown. So we'll be able to run our operations because we've made then some reserves while then things were still on our side. So that's what we are talking about. And we're also talking of a notional profit. Contract works performed usually for a period longer than accounting period. If then the contractors wait for the day of payment to determine profit or loss, the profit will look depleted. Therefore, it is therefore standard practice when it comes to the contract that in accounting, then to pay a certain amount to the contract price so they can determine their profit and losses according to the stage of the work that is completed. And we give that a name and say there's a notional profit. So in other words, this is just a profit that we pay then to our contractors based on the work then that I've done, as I've done the calculation then for you in the previous slide. So then this is then how things then looks like then when it comes then to this contract elements. We've got your contract cost, direct contract cost, indirect one, as we've indicated. Then we encounter then a huge amount of contracts or items and belongs to the direct contract costs rather than indirect. General cost, then those are other costs that we find ourselves have. So they explain then to us then the direct contract cost. So it simply means that these are the costs that are specifically for that particular contract that we are engaged ourselves with. And these are the examples then of that. So if we talk of a material that we purchase for that contract, if you hire a certain equipment or a plant, then for that contract, then these are direct costs and that relate to that particular contract. Indirect then could be the cost that are related to general project activities that are allocated to individual projects. So things then like your warehouse cost, because then on the warehouse cost, we're going to keep all the material that we're using in our contracts. That is not specific then to a certain contract. As well as your general cost, they gave you then the examples then to that. So for starters, then we are going to look at what they say as a completed contract. Remember, we said that at times we can have the contract that is longer than a year or a 12-month period. But some of the contracts, they can fall then within a 12-month period. So we can work on that contract and finish it within then the year. So that contract is a completed contract. So a separate ledger account is kept then for each contract. Therefore, the general objective is to establish the overall contract profit or the loss. So that's the main goal then here, is to say that, okay, now that we have got this particular contract, did we realize a profit or a loss? So how are we going to do that? The contract account, therefore, is divided into two sections. So we divide then the contract into two sections. The first section, what are we doing there? We determine the costs that should be included in the cost of sale for the purpose of calculating the profit for that particular contract. Because if you say that you want them to see whether you've made a profit or loss, therefore you need them to know what is the cost. In this case, then, guys, then it's not like the normal wholesaler where we buy then a completed items and we just add a markup, where it is easy there for them to have then the cost of sales. But in this case, now we're building the structure, we're using our material, labor, overheads. Therefore, you need then to do then that calculation up until you say that, okay, this is a total cost at this stage. If then the contract is completed, then you'll say this is a total completed cost that I have. So that's the very first stage then that we have. Then the balance represents then the cost of sales or the cost of work certified. I don't like the term cost of sales because in a contract, as we are not selling then anything. So the best term then that I will use then to go for is a cost of work certified, or the cost of work that we've done attributed then to that part of the contract. So that's the first part. Then the second section of the contract is to do the trading account. So where we say now let's take then this cost of the work that we've done versus now the amount then that we can claim from then the client. Remember words, I'm saying that the amount then that they say that we've got a right to claim. So in other words, then is the certified then amount. Is not the amount then that we received. We don't compare with what we received, but we compare it with what we've got a right to receive. Then with by doing so, then we can have then our profit or the loss for that particular contract. So they said that let's look at the example 10.1. So this is then the questions then that we're going to have a look at. They said then a Hogsett Limited completed contract 770 by the end of its accounting period at 29 February 20 times 8. Details regarding this contract are as follows. So you've given all then the figures that then they've used and every activity that took place. Then the client was certified with the work done by Hogsett Limited and paid for all the work certified by architect. So the contract account in the general ledger of Hogsett Limited. So that's the contract that we're going to work with. So we will look at this 10.1. As I've said that the contract account is just a normal account. Do we have then the name for this particular contract? Contract 770. That's our contract that we have. That we're going to work on. So we said, guys, then we have got two sections that we look at when we look at this contract. So our first section is to work out then the cost. So that's where then we focus on then in our first section of then the contract. Then the second one, that's what's going on now. Then the second one, that's where then we determine then our profit or loss. That's what then we are doing then when we are working then on our contract. So now looking at the quiz question. So what we need then to look in determining, guys, then or in working then with our first section where we determine the cost. We look at any expense that we have. We don't follow then your real double entry system, but we look at whether then is it an expense for the particular contract. If it has an expense, it will go to the debit side. If then it's not an expense, therefore we look at how it affects us then at the cost that we have. Because at the end of the day, we want them to see that this is an actual cost. For argument's sake, look at the first transaction. Material issued from store, from store to contract site. So we've got a storeroom in our main contract or in our main our main donor site. So we've got this contract. So we've issued then the material then from the main site then to this particular contract. The material is worth then 100,000. So in our mind, we said, okay, therefore this is the expense for this particular contract. So if you look at this and as an accounting student, you'll want then to look at your debit and credit. One I will say, okay, therefore it means that we are going to credit the storeroom here and create and the debit material account. You are 100% correct. So after you've done that, I'll say then I close off then get that material account. And to close off that material account, you are going then to credit that material account with contract triple Z or double Z0. And we debit or contract 70770. That is why then we've got then material here 100,000. So I'm trying then to take it a little bit longer so that you can have a better understanding, guys, what's going to happen. Because if we issue out material from the storeroom, therefore the storeroom account is going to be credited, material is going to be debited. Then I will close it off against the contract account. Credit your material and debit the contract account. I hope then that one is clear. Machinery purchased and delivered then at the site, 25,000. If then we say that this was a cash purchase, so we know that, okay, therefore we debit the machinery account and we credit bank because there's a money that is going out. Then we go then to this machinery account and ask ourselves, why were we purchasing then this machinery? Is because of our contract 770. So we said, okay, then let's close off the machinery account against the contract. So once again, you do what? You credit your machinery account with 25,000 and debit who contract 770. With that 25,000. I hope you do follow me. And again, remember, guys, the reason why we're doing this, we want then to work out then at our cost of the work done. I want to do away with the term of cost of sales because we're not selling here. But we are determining the cost of the work that we've done because they say it here, this contract is completed. So we need them to know then at what cost. Lease of equipment. So we decided that, okay, and we are going to, because of this contract, we're going to lease some equipment. So we've gotten this client of ours that we've leased the equipment. So we're liable to pay them. So we've got this equipment. So what is going to happen to our equipment? Therefore, automatically our equipment is going to increase. Therefore, it's a debit to our equipment. And we've got a lease account that we're going to credit. Again, then why we have to list the equipment is because of contract 770. So let's close off then the equipment account against the contract. Then we've got that equipment of 12,000. Wages paid 31,000. Paid then your workers 31,000 in total. Credit then your bank, obviously then, and debit your wage account. So we come back again and do our close off. We've got this wage account was because of the workers that we have on this particular contract. Yes, Tulani. Okay, that was a mistake, I guess. So we've got this wage paid. So we close off again the wage paid against the contract account. So debit the contract account and credit your wage paid 31,000. There's our 31,000 there on the debit side because any event again is an expense. Hence, I'm saying that you can look at that way. Okay, is it an expense? You put on a debit straight, or else then you just play then with your accounting because why not? You are an accounting student. Material returned from site to main store, 10,000 rands. So out of that material of 100,000 that we've issued, then to this contract, we are returning back then 10,000 to the main site. So ideally then now we were going to say, okay, therefore we're going to debit our store account because now it's increasing because we're returning back, and credit the material account. But we've already closed off then at that. So we will look at okay, where it is then. It's on the contract account. So we are going to credit the contract account. So we've got the material returned of 10,000. Once again, it matches well, guys, with our objective, because our objective, we want to get to know the actual expense. Now we've learned that okay, out of that 100,000, 10,000 rands is returned back then to our main site. So let's reduce then that total of 100,000. In order then to do that, because it is on the debit side, you have then to do a credit entry. Then the next thing is machinery transfer then to contract 777 on completion. So we're done now with 770. Then the machinery, they said, okay, let's transfer it then to the next contract. Now the value is 19,000. So then to do then that transfer or to determine the actual cost then for this particular contract, our machinery then it was 25,000, but then because we're using, we know that the machinery lose then at the value. So we transfer then to the next contract, 19,000 rands. We move on. Work certified by architect. Now that one, then we said, okay, hold on. Then with that, then work certified, then by then the architect. We are going to make use of that. But for now, in our first stage, we want then to firstly know then what is our work completed, because before then we can take into account the work certified by architect. Extra work certified then by the architect, we've got 23,000. Okay, then let us that also then wait for us. Architect fees paid 14,000. That's an expense. We can take then that expense. That we have here. With architect fees then of 14,000. We are still doing the collection of all the expenses at the moment. That's what then I was still busy with. Overheads absorbed 16,500. Surely then that again belongs then to this contract. It's an expense then of this contract. $16,500. My memory serves me well. Yes, I'm correct. Head office cost for this particular contract, that's an expense again that belongs to this contract, 9,700. Then we're done, guys, with all then the expenses that we have. So now we can calculate the cost of the work done. About how much it is then the cost of the work done. Can you please then add for me then the debit side? 100,000 plus 25,000 plus 12,000 plus 31,000 plus 14,000 plus 16,500 plus 9,700.
208,200.
208,200.
200.
So, in other words, then we are balancing then this account. So also then on this side, and I'll say that we were looking then for this 208,200, but I think then we are only having 29,000 on the credit side. So how much is the difference? 208,200 minus 10,000 minus 19,000. 179,200. So therefore this, instead of being a balance carried down, guys, and this is going to be our cost of work done. This 179,200. Then we take it again then to the debit side. As you will do then as a balance brought down. 179,200. Now we know then the cost. Then we can compare then the cost then with the amount then that we've given the right then to claim. So coming back then to the question, look then at the architect. The architect said that then these are the two values then that you can claim. Then we've got your work certified by an architect as well as an extra work that is certified. So you can add then those two figures. That 215,000 plus 23,000. It gives you what?
238,000.
238,000. Thank you, 238,000. So we call that now as a value of the work done or work certified by the architect. So we compare now the two. We know now the cost of the work done and the value of then the work that is done. So with then this value of the work done, and you could see then, okay, now there is a profit here. So 238,000. So once again, then to determine that profit, you balance again your account. We balance it with 238,000. $238,000 minus 179,200. How much is our profit?
$58,800.
58,800. That's it. That's the profit. So that's then what we're doing. But can you see the mistake then that the tender guys have made? Once and I want to see then the value of the work that is done and said, okay, it's 238,000. Now someone started to live the life then that is equal to 238,000. Yet then the only amount that belongs then to him or her is only 58,800. So that is why then we encountered then a lot of fraud outside there. People then try then to play hide and seek and all those things because of the miscalculation in these things. So hopeful then as the cost accountants then you are going to help them to understand, but can I look, this is then the reality of then the situation. So this is what we are doing, guys. When we talk of the completed contract, so this is how then we do then our calculations when we say that the contract is completed, and this is where then we are going to end our today's session. We've run through then the theory, and also then we look at the completed contract. As we've seen that, okay, now we've got only two things that we have then to do in our contract. The first then a part of things then is to work out, is to calculate then the cost. Okay, if then the contract is completed, even if it's not completed, but we just reached then at the end of our financial period, we first work out the cost. Then after that, we determine the profit. So next time then we're going to look at what if the contract is incomplete, but we reach then our year end as a Kanban. How are we going to do then our report? Because then at the year end, then we need then to determine the profit. Thank you then for attending and also then watching then this video. For those then who are going to watch it later,